Alright, so in this video, we want to solve a practical question to augment our understanding in borrowing cost. We already have the theory aspect of borrowing cost, so if you not watch that, you can just check on it and then watch that for your understanding. Here, we just want to solve a full practical question on borrowing cost. So we are taking the question link will be made available in the description of the video. So the link will be there, the question link will be there for you to have a look at how we go about it. So the question is, on January 2011, QRS Limited commenced the construction of a new factory and the following payments were made. So here there's a construction and the following payments were made. So we made payment in 31st January, and then it was 200,000. We also made payment on 31st March, and then the amount was 450,000. We also made payment on 30th of June, and then the amount was 100,000 for that matter. And then we also made payment on 31st of October. 31st of October, and the amount there was 200,000. We also made payment on 30th of November, and the amount there is 250,000. So that is the expenditure. So these were the expenditures we incurred for the construction of a particular asset. So let's look at the information below it. Please, the question link is on the description of the video. Kindly click on the link and you have a full access to the question. So now we're told that the first payment of the loan on 31st of January was funded from the enterprise pool of debt. However, the enterprise acceded. So this one was funded from enterprise, the pool of debt. It's not specific loan. However, the enterprise acceded in raising a medium-term loan for an amount of 800,000 at 31st of March. So on this date, they raised an amount of 800,000, which carries interest rate of 9%. And this was specifically, if you look at the question, they said, with simple succeeded in raising a medium-term loan of 800,000 with a simple interest of 9% per annum, calculated and payable in arrears. These funds were specifically used for this construction. So out of the general pool of loan, we are informing us that this loan that we have taken was generally specifically for what? For the construction of the loans. It's not from the general pool specific. This is a specific loan taken for the construction of the asset. Now the pool of debt was again used for an amount of 200,000 for the month on 30th of November, which could not be funded from the medium-term loan. Remember that the medium-term loan is the specific loan, and we are told that this one was used specifically for the construction of the asset. We were told earlier on that this cost was financed from the general pool of loans, and this one to 200,000 was also financed from the general pool of loan, because not all of them. Look at this one. We were told that 200,000, but here we have 250. That means 50 could probably be financed from what? From the specific loan. And the remaining 200,000, they are telling us again that it was financed from the general pool of loans. So let's continue. They said the construction project was temporarily halted for 3 weeks in May due to substantial technical and administrative work being carried out. So this is substantial technical and administrative work. It is important that they carry out that work, so we will not suspend capitalization in that period. And it is assumed that the management of QRS adopted the policy of capitalizing borrowing costs. Now let's look at the funds available to us as at that date. So they said we have the medium-term loan of 800,000. We have the bank overdraft of 750, and we also have the 10%. So here we have the other loans available to us. We have 750, which is a bank overdraft. You see, bank overdraft, when you take it, there's no interest on it. So here they have calculated the interest for us to be, so the interest on it, the interest on the is 33,800. These are the loans you've taken in this general pool of loan. The specific loan is the medium term, and then we were also told that we also secured a loan of 10 million, which is having an interest rate of 10% in October. 2010. Here our focus is in 2011. Our focus in 2011, and that they took the loan. This loan was taken on in October 2010. So probably the loan is a 7-year loan, so it will be available for us to use in 2011. In 2011, the loan will be available for us to use in 2011. So everything will be capitalized on the 10 million loan. But remember that these two loans are general pool of loans, while this one is a specific loan taken for the construction of the asset. Now let's go back to the statement again. We were told that these funds were specifically used for the construction, and excess funds were temporarily invested. So the excess funds of this, which was specifically taken for the construction, excess of it was invested at a 6% per annum monthly in arrears and payable in cash. So we are told that the excess of the loan that was taken was invested for investment income. So how do we get this whole thing? So first, this is a whole question. Let's look at the requirement of the question. The requirement is that calculate the amount of cost to be capitalized. Calculate the amount of borrowing cost to be capitalized. That is the requirement of this question. So first, let's determine our investment income, because the question said excess of the specific loan taken was invested. How do you get that? So let's look at that. Let's have a small schedule for better understanding. So let's have our year over here, and let's look at our loan. Here we are looking at the specific loan because the essence of it was the one that was invested. And then let's look at our expenditure over here. Let's look at the loan that is left to us, or the loan that is the excess loan. Okay, so let's look at the excess loan over here. And then we can here look at our interest over here. So we took the loan on 31st of March, a loan of 800,000, and the expenditure on that date was 450,000 from the question. This from the question. So we took the loan on 31st March, and then the excess will be 350. So it is this excess that is going to attract the interest. Is that okay? Because this is the excess. As at this day, we have spent 450 of the specific loan, and therefore this is the excess. This is what's supposed to attract our 6%. But let's look at something. From March to June, we have incurred another expenditure again. So that means this excess loan would have been reduced again by what? By this 100,000 expenditure in June. Therefore, your interest will be charged on this 150 from only April, May, June. So for only 3 months. So here we are supposed to multiply this by 3 over 12. Why? Because the question said that it is our excess loan that we invested. If that's the case, we have spent 450 in March, and from March to June we are spending another one. Then in June, this 350 here will be shortened again. It will not carry the interest for the 350. It must be lessened by by the 100. So in this case, we are supposed to charge only 3 from April, May, June. And let's go to June. What is happening on 30th of June? Now we are left with a loan of 350 over here, and then our expenditure in June is 100,000. So here the interest left will be 250. So to multiply by 6%, multiply by how many months did it take us before we get to the next expenditure? So is this year we are going to have from July, August, October. July, August, September, October. July, August, September, October. So 4 months in this case is going to be times 6%, which is 4 over 12. We'll give it our investment income for the second one. The next expenditure was on 30th of November. So here we are on October, 31st October. Now we are left with a loan of 250. Now on 30th October, how much are we spending? We are spending 200,000. And then please remember this one, we are letting it to get the excess loan over here. So we take this one from this, we are getting what, 50,000. So we are spending this on this day, so it will be 50,000 that will be in the investment, portfolio from 1st November to 30th November. So here we have to multiply by 6%, multiply by 1/12, because from October to November is just 1 month, which will give us the investment income over here. Then again, 30th of November, we are now left with 50,000, and our expenditure too is 250. We cannot take all the 250 in the 50 here, so here will be what, 0. So 30th November there will be no interest for us. So please, this is how to get your investment income. So let's multiply to find. So we have 350,000 multiplied by 0.06 multiplied by 3/12, and it's going to give us 5250. So if you do it correctly, you are going to get 5250. So let's look at the interest for the second one, which is going to be the 250,000 multiplied by 0.06 multiplied by 4/12, and it is going to give us 5,000 over here. 5,000 over here. So let's assume the amount are in dollars. So the next one is going to be 50,000 multiplied by 0.06 multiplied by 1/12, and this is going to give us $250. $250. So our total investment income is going to be this. This will give us 5,500. It's going to give us 10,500. 10,500. That is our investment income. So please, this is how to get the investment income from the question. Why? The question is saying that our excess specific loan is the one that is invested, not all the loan assets. So that means we are supposed to first take the expenditure first before what we capitalize or we charge what our investment income. Now let's look at the rest of the question. Now we have gotten our investment income. Now let's look at borrowing cost. Borrowing cost on specific loan. On the specific loan. Borrowing cost. So here we know that we took a loan of 800,000 multiplied by a percentage of 9%. Now remember, when we should start capitalization, the conditions that the borrowing cost must be incurred, the expenditure must be incurred, activities necessary for to prepare the asset must be incurred. So we took the loan on 31st of March. And remember that the construction of the asset will last from 1st of April up to December. So here we are supposed to multiply here by 9/12. Whatever we will get here, we have to less it from what? We have to less our investment income from it. We have to less our investment income from it before we can get our borrowing cost from what? From specific loan. Remember that the asset will be in the business till we are going to construct it till the end of 2011 from the question. And also remember that it is on this date that we are all the conditions of the borrowing costs are incurred. So we are supposed to start capitalizing from this date. So from April 1st to December is going to give us 9. So in this case, our borrowing cost is going to be 800,000 multiplied by 0.09 multiplied by 9/12, and this will give us it's going to give us 54,000 minus our investment income, and it's going to give us a borrowing cost of 43,500. So we are having a borrowing cost on the specific loan of 43,500. That is our specific borrowing cost from our specific loan. Now let's look at the borrowing cost from our general pool of loans. We add it to this to get the borrowing cost for the question. So let's quickly calculate the borrowing cost here. First, we are supposed to determine our capitalization rate, and it's going to be the interest plus what? The addition of the 2 interest divided by the total loans taken. So here we took a loan of 750, which is a bank overdraft. Bank overdraft, the bank you see, it's a short duration, so it doesn't come with what? An interest rate. So if that's the case, the bank has already calculated the interest for us. So we have to determine the interest on this, and it's going to give us 1 million for that matter. So it's going to be 33,800 plus 1 million, because it's 10 million and 10%, so 1 million over here, all divided by our total loan, which is 10.750 thousand, all multiplied by 100, all multiplied by 100. So here we are having 33,800 plus 1 million, all divided by 10.750 million, all multiplied by 100. So if you do it correctly, you are going to get 9.6%. So 9.62%. So we are leaving it at 2 decimal places because it's 9.616%. So now here, let's determine our borrowing cost from the general pool of loans. So in these questions, we were told specifically that it is the expenditure on 31st January and then expenditure on 30th November that is going to be spent from a general pool of loans. The question has specifically informed us. So let's take the first one. This is January. Then the cost there is going to be 200,000. Please remember that we charge the capitalization rate on the cost with the borrowing cost with the general pool of loans. We charge the capitalization rate on the cost. So I have this in the explanation of the video. So if you don't have it, please kindly look at that. So it's going to be this multiplied by 9.62%. Now we are spending here, so we are left with from February to December. So here is going to be multiplied by 11 over 12 to get us our borrowing cost. And then the last expenditure we were told was 30th November, 31st December for matter. So here we were told that 200,000 again was spent from that, multiplied by 9.62%, multiplied by 1 over 12. Why 1? Because the expenditure is on 30th November and it's just going to take us just one month. So here, let's do our calculation. So we have 200,000 multiplied by 0.0962 multiplied by 11 over 12. This is going to give us 17,636.67. And then the second one, which is 200,000 multiplied by 0.0962 multiplied by 1 over 12. And it's going to give us 1603.33. So this is the two, we added 2, so 17,636.67 plus 1603.33. We are going to get, the 2 is giving us 19,240. Then we add it to our specific loan of 43,500. So these two loans is giving us 62,740. So the borrowing cost to be capitalized is our 62,740. And remember that the question is how much borrowing cost to be capitalized. That's why we will leave it here like this. If not, we would have added the cost, all these costs to it to get our total cost to be capitalized. If the question is what is the cost of the asset, then you add your borrowing cost to it. Please remember that you take the borrowing cost from the general pool of loans separately and from the part of specific loan separately. Another question would be like, why is it that just after this one with the general pool of loans, we jumped up to the 200,000 in November? Remember that I said anytime we take a specific loan for the construction of an asset and we also take a general pool of loans, they are all in the question, then we will first have to less our specific loan from all the assets, from the cost of the asset, and whatever is left before you will charge our capitalization rate on it. In this question, our specific loan was taken from December, so we take this one from it, we'll be left with 350. We take this one, we'll be left with 250. We take the 200, we'll be left with what? 50. So here it is 250, but 50 of it is taken care of by the specific loan. That is why when we came here, we have for 200,000 here to not 250, because 50 of it was taken care of by what? By the specific loan. So this figure here will give us what? Our borrowing cost to be capitalized. So that is it for this question. So the link will be in the description, so kindly check the link and to get access to the question and its solution. It's really what we have in this video.